Axel Merk, CIO and founder of Merk Investments, which now has just over $2 billion in AUM. It is so great to see you again, Axel. Great to welcome you back on the show. It's been way too long. I think the last time we spoke was right after the Silicon Valley Bank collapse, which was it was 2 years ago. So welcome back. Great to see you.
Great to be with you. And on that note, nobody's talking about that anymore, right?
You know what? They're not.
The emergency packages have just run out about a week or two ago. So, and the world still stands. So sometimes that can happen, but we live another day.
There you go. Well, since it's been so long, it's been 2 years and a lot has certainly changed in that time. Let's step back. And I know you as a macro expert, so even better to frame up the conversation this way, as we always do with all of our guests, Axel, is the big picture macro view, where we are today as it relates to the markets and the economy and that framework that you are looking at the world today. And as you know, you can take all the time you need to set the table when it comes to that macro picture.
Sure. And again, great to be with you again. Let me frame it in a way maybe that's of interest to your audience and not repeat what everybody else is saying. Not that I disagree necessarily with what everybody else is saying, but usually we look at the world through a prism of monetary policy, fiscal policy, maybe geopolitics, and those are all correct and are certainly dimensions to look at. The other dimension, though, that I think is its own dimension is executive policy, right? We all know that President Trump is doing a lot of things with executive action through executive orders. And of course, there are fiscal elements in that. And especially tariffs would usually be in the purview of Congress, but especially in the 1930s, that power was handed over to the president. The reason I mention that is because if he is effective in that, and if he does more than some simple tax raising, that may well profoundly change the plumbing of the financial system. And that's the angle I'm touching on, just to add something beyond what you hear from your guests all the time already anyway. What I mean with that is that already since the 1980s, Trump was talking about other countries, quote unquote, ripping off the US. So he has a profound dislike towards trade deficits. And he focuses on goods. And of course, goods are a small portion relative to services, but especially the Europeans are talking about retaliation on services as well. And so I would like to see that as a group. And so to the extent that he's rigid, and that's a huge caveat, because we can call it pragmatic, you can call it tactical rather than strategic, whatever you may want to call it. But if he is serious about imposing that, I like to remind people that this trade and services deficit is really part of the entire current account balance. It's the balance of financial flows and goods and services. And when you disrupt one, you're going to have an impact on the other. And I say that in the context, of course, of substantial deficits in the US that, at least historically, have to a significant extent been financed from abroad. And I'll just pause it here because I don't want to talk for hours about it, but that gives you a little taste, right? If these actions impact or have unintended consequences on financial flows, that may well have rather profound impact in the medium term. And I'll be glad to expand on it, but I don't want to monopolize this conversation.
I like that. You piqued my interest. I would love to expand on it because you're just talking about like an entire like reworking of the financial plumbing, as you put it, and all of the financial flows. What are the consequences? Let's explore that.
Yeah. Well, so first of all, the markets, while we've seen some hiccups, they are not screaming, oh my God, the entire world is about to change completely. You'll see some ups and some downs. Obviously, the price of gold is zooming higher, which I think is a warning signal in that direction. But what I'm about to tell you is you can call it a risk scenario, you can call it an opportunity, depending on your position. And again, right, Trump tends to take two steps forward, one back, one sideways. So I'm not suggesting it will exactly happen this way. But the context of all this is that the way I look at the US is the US is like a giant hedge fund, or a giant bank, if you want to call it that way. The US kind of takes money and invests it abroad in search of higher returns. And foreigners do that as well. They borrow US dollars to invest in their own countries, mostly because, of course, they don't get funding locally, and the US has deeper capital markets. Through that, we call it the exorbitant privilege. The US is able to run deficits that are significantly higher at a very low cost of financing it. And so if you frame it from that point of view, the question is, if you throw a wrench into that global plumbing, whether the US will continue to be able to exert its exorbitant privilege. That's really the concern that I have, that will weaken. And because of the actions, it might weaken substantially. So I'm not suggesting that all the motivations for doing some of these trade things are not in the right place, but there may well be very significant unintended consequences. And so the things to look at is that if the funding from abroad is not going to be as extensive anymore as it had been previously, you should see that in higher funding costs in the US, or in the absence of that, you would see the Federal Reserve facilitate all of this a little bit more. We've, of course, heard Trump provide some pressure on the Fed. Now, every president loves to blame the Fed for things that go wrong. It's a wonderful punching bag, aside from the fact, I mean, there are things I don't like about what the Fed is doing and whatnot, but just politically, it's convenient to blame the Fed. It's really important who the next Fed chair is going to be, because that's going to send a signal as to how earnest that pressure will be. But at the other end of the spectrum, should there be significant disruptions, and the reason I use the word disruption is, keep in mind, we have a highly levered financial system, and so if you throw a wrench into that, disruptions are possible. We know from Mr. Draghi at the European Central Bank that central banks do whatever it takes when push comes to shove. And so there will be quote unquote solutions to any problems that arise in that. But I would like to have people kind of just pay attention to any of these actions that come, to what extent they might impact financial flows, and keep a keen eye on that.
So let me ask you this then. As someone who is an observer of all things macro, and you mentioned that your point of view is a little different, or the way you look at the world is a little different, which is wonderful. I love that. And I love exposing my audience to different points of view. Are there things that you observe in the macro space that you're like, they're totally getting that wrong, or they're misinterpreting that? Maybe even in the financial press even. What are some of those common misconceptions, narratives that you're seeing right now?
Well, the market is always right? So when I see the market price things differently from how I might price them, you can say, oh, that's an opportunity. But the first thing I'm trying to do is saying, well, what am I missing? Because the collective wisdom is presumably better than my own wisdom. That said, I've been around the block a few times. Actually, last year had the 30th anniversary of our business. And so I've, of course, been opinionated and put my position there. I tend to be early with my views. I was concerned about the financial crisis that happened in 2008, starting, I think I went public in 2005 with my concerns. And of course, even by the way, if you can have a crystal ball and predict things, doesn't mean you'll make money. Because in 2008, the rules of the game were changed several times. If some of the risks I just articulated unfold, I am all but certain that some rules of the game will change along the way. And so making money of all this is much more easily said than done. Regarding what you asked about what the market gets right or wrong. First of all, the indicators I look at is not so much whether the S&P goes up or down. I mean, the S&P is expensive, and it will give it a narrative as to why it may be plunging or not. I'm looking at the bond market more. Longer-term indicators in the bond market tend to give a lot of insight as to the confidence that the market has in the Federal Reserve. And I'm looking not so much at the normal level of yields, but real interest rates. If those change, if inflation expectations change, The market has no idea what inflation will be in 10 years. The Federal Reserve doesn't, you or I don't, but it's a metric about the confidence the market has. And little nuances will happen all the time, but it's that sort of thing that I look at. And then, of course, one of the things, one of the more contrarian indicators is, you mentioned earlier that we have $2 billion under management. Well, we had $1.6 billion at the end of last year. And so I don't know what everybody's complaining about the markets, but the contrarian indicator here is we are invested on the gold and gold mining side, and the fact that we've had a surge in assets suggests that we had counter-cyclical, right? 2008 was a good year for us. And so that somewhat suggests to me the market might be missing something. That may be the most imminent thing of what might be missing, that gold is sending a warning that something is happening here, right? Because what I'm describing, you could potentially see much more disruption in the market, and you don't see it. And that could have two reasons. One is that either I'm wrong, or the market has confidence that should there be a disruption, that it will be fixed right away, because the Fed has a lot of tools and has shown that they're willing to deploy them.
Monetary Metals offers you the ability to grow your wealth outside the banking system and gain greater control over your finances through gold. Increase your precious metal ounces every single month. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities to earn 4% on gold, paid in gold in their marketplace. And the interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. You mentioned gold as a warning signal. Gold also had a phenomenal year last year as well in terms of performance. What are some of the drivers behind gold's performance? Has it been behaving as expected, for just from your point of view, as someone who's been in this space for a long time? Because sometimes I wonder, stocks had a great year too. So I'm curious, what's been going on with gold and what are folks missing?
Sure. Well, let me go high level and then a little deeper. So first of all, the sort of gold investors we see are the folks that invest because of diversification. Gold in the long run has a near zero correlation to equities, but it phases in and out. And so when people are concerned about the S&P 500, gold gets more attention. The second driver is people concerned about the purchasing power of the dollar, the deficits, right? And those investors have moved kind of from the fringe more to the mainstream. So there has been significant more interest. Then you have the speculator. Those have moved more towards the meme stocks, but especially in recent weeks, digital assets haven't done so well. So you've seen some of those guys nibbling with gold. And then, of course, you have foreign central banks that have increasingly participating. And let me expand on that has a lot to do with, I think, the weaponization of the dollar, providing an incentive, let's phrase it politely, of foreign actors that may not be so friendly to the U.S. to take some of their investments in the U.S. and move them to other assets. That money is not all going to make it into gold, but gold is a beneficiary in that trend. Now, the last point is somewhat also related to the purchasing power investor, in the sense that the one correlation that gold has historically had, not perfectly so, but is to real interest rates, right? And I mentioned that longer term real interest rates are an indication of the confidence in the Fed. And if you think about it, gold doesn't pay a dividend. It's a brick, like a barbaric relic. Why would you hold gold? Well, you hold it if you think that the purchasing power of cash is eroding. And that correlation has broken down. Now, that could be short term, but it makes sense for that to break down in the context that happened around the time when the dollar had increasingly been weaponized. And to me, that is consistent with the story that I told you about the potential changing of the plumbing of the financial system, when those sort of correlations start breaking down. Now, again, right, it's correlation, doesn't prove causation. These are symptoms. So I might be reading too much into that, But those are the sort of things that I'm spending time thinking about to see what could possibly be wrong in my analysis because the market doesn't quite yet jump onto that bandwagon.
Mm-hmm. So, not to get too much into, the details here, or what you can share or you can't share, but I take it, okay, gold is an area of focus for you all, gold miners as well. I don't know if I'm allowed to ask, but I'll ask and you can answer if you want. Are you a buyer of gold at these levels? Are you holding? Like, how do you, whatever you are allowed to share?
Well, there are two things, right? Institutionally, we have a mandate. We have one product that doesn't have inflows and outflows. We have one product that does have that. There we have seen inflows. Personally, I'm on record of being a significant buyer in the gold mining space. So that, I suppose, puts me in the buy camp. And I do hold quite sizable positions in gold as well. And I'm not allowed to say what I'll do in the future, but you can take from that I presumably wouldn't have been a buyer if I weren't positively inclined.
Got it. That's fair. Okay, so going back to just the changing in the more of the global financial system, the plumbing, as you put it. For folks watching and listening to this, what might that mean for them? How might it impact just more of like we have a mix of the audience. We have a lot of like professional investors, retail investors, and then people who are just genuinely just curious about markets and investing in economics.
Yes, a lot of people watching and not acting. And watching is a wonderful sport, but that's not a good investment strategy. But I say that just out of my cynicism that I've grown used to over the years. The important thing for investors, I think, is to have an investment process. It doesn't matter really how good that process is. What really gets you if you don't have a process at all, because that means that you're going to be swayed by the latest thing you hear. And rather, if you have a process, you can test that process against new information. And beyond that, I mean, it's about the risks you can afford to take, right? Can you afford to be in the S&P or can you afford to be in cash? If you need to chase returns because you don't have enough income, that's usually a bad setup. One of the things I said already, I think it's 20 years ago, is that there's no such thing anymore as a safe asset, and investors might want to take a diversified approach to something as mundane as cash. And what I mean with that is the traditional capital allocation model has an anchor of a risk-free asset, and then you build your risk portfolio around it. Well, just from a math point of view, you can optimize a model without having a core risk-free asset. But what it means is that the sophisticated investors will presumably do okay. It is the mom and pop saver, the middle class, that will suffer in that. And to me, this goes way beyond trying to optimize your portfolio. To me, the rise of populism we have seen, not just in the US, but globally, is a direct result of the erosion of the purchasing power that investors have. And so I talk all with this fancy language about investments, but there are socioeconomic implications of that. And once you go down that rabbit hole of having instability, it unleashes an unstable dynamic. A few years ago, we cautioned about stagflation. We even created a stagflation product. And the reason I can talk about it is because we shut that product down again after we didn't have enough demand. But we didn't set it up because we thought it would be a short-term product, but because we thought it would have legs. And the reason it would have legs is because once you are in this unstable environment, the politically convenient reaction is often the economically wrong one. And let me give you the most recent example. President Trump suggested that the Federal Reserve should lower rates to help with the tariffs. Well, the way tariffs can be thought of is a supply shock. You have fewer goods coming in because the cost of getting them in is more expensive. So if you lower rates, that's going to create more inflation. That is not the fix. You actually should tighten monetary policy in reaction to that. But politically, that's suicide. And so it's one of the things I said at the end of last year is one of the best investments for this year, maybe popcorn. You buy a bunch of popcorn and sit back and enjoy the show. And I continue to bet on popcorn for the foreseeable future.
So maybe in other words, don't do anything.
Well, no, it's about assessing whether you can afford the risks, and no matter what you do, you're making a risky decision, right? There is no place to hide. That's one of the challenging things. I happen to be very comfortable with the gold and gold mining space, but kid you not, it's a very volatile space. It's not for the faint of heart, and so I'm not suggesting everybody should pile their money into it. But whatever you do, you might want to do a gut check whether the sort of things that you're allocated to make sense. And whether you have rebalance at the very least, or whatever you do to kind of fulfill your own investment process.
Axel, am I hearing you right that the stagflationary risks, those still remain?
Definitely. I mean, you saw it at the latest press conference of Powell, right? The economic growth was downgraded, inflation was upgraded, and no change in interest rates. And the initial market reaction was dovish. There was somebody on Bloomberg said, well, maybe this is hawkish because normally when you have low economic growth, you would suggest you'll have more rate cuts. And I would agree with that. This was not dovish. They are stuck. I mean, they're partially stuck because it's a debating team and they don't know what to do. And so they just want to be slightly on the constraint side. And I've often accused them of not having a proper strategy, but yes, and by the way, Powell was asked that about similarities to the 70s, and he shrugged it off. He was a little miffed about getting that question in the first place, but of course, history rhymes; it doesn't repeat itself. But no, the challenge once you've had a supply shock and high inflation, the sort of stagflation environment we had is things aren't linear anymore. And so you can't just wait for inflation to come down, and it is in some ways the correct kind of reaction to that to just be a tad tight on the monetary policy, but Powell doesn't dare to articulate it that way.
Okay, so if the stagflationary risks are certainly still around, they're on the table. How are you thinking about the economy, where things might be headed?
Yeah, and by the way, I should balance that, because we haven't talked about that. There are, of course, drivers to unleash growth in the economy with cutting regulation, right? Unleashing the animal spirits and all that. And I wouldn't, currently that's in the background, simply because all these executive actions, people will not invest if the rules change every other day. But at some point, presumably when Trump has achieved some of the things he wants to do, he will focus more on that side of it. And there is significant growth potential that can be unleashed, that is underneath the headlines. Which of these forces will ultimately win remains to be seen, right? There's lots of things that can happen. But the deregulationary push is very substantial. We just had another executive order signed on strategic minerals, to which, by the way, gold was included. That was a bit of a surprise to the market, which should speed up the permitting process in many of these things, might make government funds available. The Department of Defense might be able to invest in the mining of strategic minerals. All kinds of stuff may happen. So there are certainly growth opportunities. You know as much as anybody, right? The recession that's been predicted for years hasn't materialized. In part because the Federal Reserve has patched up the economy. You mentioned the bailout of the banking system from years ago. When you make failure impossible, of course you're not going to have a recession. As far as the markets are concerned, though, it matters much less what will happen. It matters much more what the risk is, what might happen. So if you're concerned about something happening and you think it's significant enough, you take it into account in your portfolio. It's like the carrot that's held in front of the donkey that the donkey never catches, but you're always walking in that direction.
I like that. In markets, it matters much less what will happen. It's what the risk is, what might happen. So let me ask you this, because You often talk about, from investing, you want to be able to sleep at night, right? Based on how your portfolio is constructed. If you're staying up,
which is, by the way, the much better risk indicator than
yeah,
the mathematical symbol of risk and variance.
that
Can you
is,
sleep with this stuff at
and
night?
that is something you have taught me on this program. So the question, and I'm not saying this is an investment thing, but maybe the question is, what is the risk out there that is keeping you up that's keeping you up at night? Maybe not literally, but what is someone that's on your mind that is kind of keeping you up?
Well, I mean, I try to get a good night's sleep, and I'm very I try not to look at the news before falling asleep. That makes me fall asleep much better. But no, I mean, quite seriously, I'm trying to keep a balance in life. That's what keeps you up at night. I mean, I'm wired to see problems lurking behind everything, and say you have to just try to take it rationally. And as far as your investments are concerned, right, you want to keep things in a way that you'll be okay. That's the short of it. But you have to take into account that volatility can surge. I mean, to go back to gold, right? Gold is kind of doing its thing, has the volatility, but the equity markets minus a little higher. But then there are these spikes that can go substantially up or down, right? I mean, we love it, of course, when gold goes up, but the same thing can happen in reverse. And so you got to be able to comfort with that. And when people do get antsy, that is the prime signal that they're overexposed. Now, it's called panic for retail investors. It's called risk management for professional investors. It's really the same thing. We just use fancier terms when it happens to professional investors. So I personally do it by being highly diversified. I mean, aside from gold and gold mining, I invest in real estate, both in the US and internationally. I invest in forest and other things, right? I invest, but that's probably not my most powerful investment, in a vineyard type of thing that I take care of it myself. So you try to diversify, and it's of course easier said than done when you're just struggling to get by. When you're struggling to get by, the key thing is that you keep your expenses lower than your income and invest in your own earnings power. I mean, those are not portfolio allocation recommendations, but it's the basics that matter in a volatile period.
Makes sense. But is there a risk for you that's lingering out there that's on your radar?
Well, yes. I mean, that's why I have a good allocation to gold and gold mining. It's that our policymakers do what I expect them to do. That's the risk. And I'm an equal opportunity offender when it comes to politics, by the way. And you ask me whether I'm a buyer or seller of gold. I will sell my gold when I have a feeling that our politicians have come to their senses and will truly fix long-term entitlement issues and will align the interests of the government with those of investors. The quote-unquote risk of that happening, I currently consider quite low, but that's the sort of thing. If that were to happen, then I would say, oh my God, why am I so substantially allocated to the sort of things that I'm allocated to?
It's definitely not likely to happen. I take it. Okay, but speaking of our entitlements, though, just maybe more of our debt situation more broadly. I'm pulling up right now. Let's see, where's this U.S. debt clock these days? I know it's 36.6 trillion, ticking higher. But I'm also looking at the Doge clock, 237.6 billion on the Doge clock. When you kind of think about our debt situation, the deficit issue as well, Doge even trying to make some progress, if you will. How do you think about the situation that we are in the U.S.?
Well, I put the Doge thing, as you call it, into the popcorn category. And I mean no offense. There can be very sizable adjustments to government expenditures. And it's obviously a huge political battle taking the U.S. back to more, on the federal side, to more its fundamental basis. If these things are not supported by acts of Congress at some point, some of these things will come back. But they don't fix in my view, much bigger issues, which is Social Security, Medicare, those sort of things. That's really what drives the deficit. Everybody loves a good story about waste. And those make fantastic headlines, but they don't fix entitlements. And so now, does it mean it shouldn't happen? No, I'm not suggesting that, right? But it means that as far as the overall deficits are concerned, it's unfortunately a drop in the bucket. Now, it can be a big drop if it's done effectively, but we do need much more than that. We do know from Europe that policymakers will get their act together if and only if the market forces them to do so, because otherwise there's no incentive. And by the way, talking about Europe, we haven't talked about this much. Germany just passed the constitutional change. They want to, quote unquote, rearm. They want to spend 500 billion euros on that. In order to get the constitutional change done, they needed to promise another 500 billion euros in infrastructure spending. The European Union announced that they want to spend an additional 800 billion euros to help rearm. I might add, and by the way, President Lagarde of the ECB has said that an investment in defense is an investment in innovation and thus productivity. So she shrugs off that this might be inflationary. I would like to ask my European friends, what is it that that Europe has to be able to ramp up any defense spending? There's going to be huge waste in ramping that up, and so we have fiscal contraction in the U.S. on the DOGE side of things, but the rest of the world, and I include China in that still is fighting a housing bust. There's going to be reflationary efforts there.
So inflation will continue to be an issue.
I happen to think that we cannot rule out that risk, right? Now, in the short term, yes, we are contractionary in the US, and that's what these DOGE efforts are, right? You reduce government spending, and if we do get a recession, that may well what's pushing us over that fence.
I have to say, Axel, it's been great having you back on. Before I let you go, take the last few moments here. Let folks know where they can find you, your work, anything that you want to share or plug with the audience. And let's leave the audience with some parting thoughts. Anything that you would like to leave them to think about, the floor is all yours.
MerkInvestments.com is our website. We are active in the gold and gold mining space. Check us out. We didn't talk about the miners too much, but there's some information there. There is a newsletter there you can sign up. You can find me on Twitter at Axel Merk. That's probably the best way to stay in touch with me. I can't talk about products there, but MerkInvestments.com, you will see more. And as far as investment advice, other than popcorn and parting thoughts is concerned, investing in yourself is probably one of the better things you can do. You have earnings power, you have control over that investment, and that is one of the more predictable things you can do in this market.
There you go. Invest in yourself. Axel Merk, founder and CIO of Merk Investments. Great to see you again, as always. And thank you so much for being so generous with your time, all of your knowledge, your wisdom, and also for just being incredibly kind and supportive of this show. I really appreciate you, Axel.
I followed you since the beginning. I love the show.
You are one of our originals, like from one of the probably first, I want to say like probably 30 guests who came on this show. So I really appreciate that. And you're one of those guys on social who's always been incredibly kind. So thank you, Axel.